When you think of a bank, you likely picture your neighborhood branch, a local ATM, or perhaps a simple car loan application. These retail institutions are built to serve everyday people, managing our personal savings and providing the credit we need for daily life. But there is a vast, hidden parallel universe of finance that most people never step foot inside. This is the world of investment banking. Unlike your local branch, investment banks do not deal with individuals. They operate exclusively behind the scenes, far from the public eye. Their clients are not you and me. Instead, they work with massive global corporations, national governments, and powerful institutional investors. So, what do these elite institutions actually do all day? Think of them as the ultimate financial matchmakers for the world economy. They operate in a high-stakes space where millions and billions of dollars are moved in mere seconds to keep global markets functioning. Their first major pillar is raising capital. Imagine a growing startup that needs to build a massive global factory to expand operations. They need billions of dollars to make this happen. They cannot simply walk into a local bank branch and ask for a standard loan. The scale of their ambition is far too large for traditional lending. Instead, they turn to the expertise of an investment bank. The bank steps in to help the company access the public stock market. This is where the famous process of an initial public offering begins. The investment bank acts as a vital bridge, connecting the company that needs cash with the public investors who have capital to spare. First, the bankers perform a deep analysis to value the company accurately. They must determine what the business is truly worth today. Next, they work to set a strategic share price. This is a delicate balancing act to ensure the stock is attractive to buyers. Once the price is set, they sell those shares to the public or to massive investment funds, effectively raising the necessary capital. But what if the company does not want to sell equity? Sometimes, they prefer to borrow money rather than give away ownership stakes. In these cases, the bank helps the company issue corporate bonds. These are essentially massive, formal corporate IOUs issued to investors. By facilitating these complex sales, the bank ensures that companies have the fuel they need to innovate and grow their reach globally. This process of capital formation is the engine of modern industry, turning ambitious corporate plans into tangible, real-world infrastructure. Job number 2 for these institutions is mergers and acquisitions, often referred to in the industry simply as M&A. Have you ever wondered what happens when one massive tech giant decides to buy another for $10 billion in cash and stock? It is not as simple as two CEOs shaking hands and transferring money. These deals are incredibly complex and involve immense risk. Investment banks act as elite consultants and lead negotiators throughout the entire, often grueling process of corporate consolidation. They must evaluate both businesses to figure out their true market value. This requires deep financial modeling and industry expertise. They structure the deal to ensure it makes sense for shareholders. Every detail, from tax implications to future growth, is carefully weighed. They also work to ensure everything happens smoothly, navigating the complex web of international laws and potential regulatory roadblocks. Without this expert guidance, these massive corporate unions would likely collapse under the weight of their own complexity. The third pillar of their business is trading and market making. This is where the sheer speed of the financial world becomes apparent. Investment banks operate massive, high-tech trading desks. These floors are the nerve centers of global finance, buzzing with constant activity. They buy and sell financial products on behalf of giant clients. These clients include pension funds, hedge funds, and sovereign wealth funds. Beyond just executing trades for others, they also act as market makers. This is a critical role for the stability of the entire system. Being a market maker means they stand ready to buy or sell securities at any second, regardless of the market conditions. By always providing a quote, they ensure that global financial markets keep moving smoothly and that liquidity never dries up. If you want to sell a stock, there is always a buyer on the other side because of these market-making desks. This constant flow of trade is what keeps the global economy from seizing up during times of uncertainty or market volatility. So, how do these massive institutions actually make their money? It is a very different model from your local retail bank. Retail banks typically profit on the spread of interest rates. They pay you a little on savings and charge a bit more on loans. Investment banks, however, operate almost entirely on a fee-based structure. They are paid for their specialized knowledge and execution. They charge multi-million-dollar advisory fees for guiding companies through complex mergers and high-stakes corporate acquisitions. These fees compensate the bank for the thousands of hours of research, legal coordination, and strategic planning required for each deal. They also take a percentage cut, known as an underwriting spread, for helping companies successfully sell their stocks and bonds. This performance-based model aligns the bank's interests with the success of the client's capital-raising efforts. The more successful the IPO or the bond issuance, the more the bank earns. It is a high-pressure, high-reward environment. It is important to note that these banks do not just sit on money. They move it, structure it, and facilitate its growth. They are the architects of corporate finance, designing the structures that allow businesses to scale from local shops to global titans. While a retail bank is like a utility for your personal life, an investment bank is like a specialized engine for the economy. They provide the lubrication that allows the gears of global industry to turn without friction or delay. Without these services, the ability for a company to raise billions for research or expansion would be severely limited. The complexity of these transactions requires a level of sophistication that only these specialized institutions can provide. From the initial valuation of a startup to the final closing of a multi-billion-dollar merger, they are involved in every step. They are constantly analyzing market trends, economic data, and geopolitical shifts to advise their clients on the best path forward. This constant cycle of raising capital, merging companies, and trading assets defines the modern financial landscape we live in. It is a world of intense competition, where the brightest minds in finance work to out-strategize their rivals every single day. The influence of these banks extends far beyond Wall Street, affecting the products you buy and the jobs that are created. When a company expands, it hires more people. When a merger succeeds, it can lead to better technology and more efficient services. These banks are the silent partners in the growth of the global economy, often working behind the scenes for years on a single deal. Understanding their role helps clarify how the massive numbers we see in the news actually translate into real-world business growth. In short, while retail banks manage your personal savings, investment banks fuel the expansion of the global economy. They are the essential facilitators of modern capitalism, ensuring that capital flows to where it can be most productive. The next time you hear about a major corporate merger or a new IPO, you will know exactly who is working behind the scenes.